We have many words in the vocabulary section about saving money. The first one is deposit. Deposit can be a verb and it can also be a noun. In this case, it's a verb because we see to put. Then we know it's a verb. So to put money in a bank. So do you have any money? If your parents give you some allowance maybe every week, maybe you could ask your mom or your dad to help you make a bank account and you can deposit. When you put money in the bank, you deposit the money in the bank. You could also make a deposit. In that case, it's a noun. To make a deposit. A deposit is the act of putting money in the bank. That's a noun. So it can be a verb or it can be a noun. To deposit money in a bank or to make a deposit. Okay. Next we have in return. If I give you something, will you give me something in return? In return is as a way of paying someone for something. When you go to the store, right, and you want to buy a key, no, I'm just kidding. That's some other situation. You want to buy candy or a toy, right? You give the store owner or the person who works at the store, you give them some money. In return, they give you the object that you want to buy. This picture shows maybe somebody's buying a car or maybe they're buying a house or something. That's not a lot of money to buy. Well, I don't know what currency is that. Oh, I thought that was Korean money. I don't know what currency that is. So I'm not sure how much money that is. But maybe they'll make many payments. But anyway, you give money. In return, the person gives you something else. So you give someone A, they give you B in return. Okay? It's a way of paying someone for something. Okay, the next word is interest. Now, interest, are you interested in this lesson? Okay, well, that's a different meaning of interest, right? So, but anyway, in this case, we're talking about interest at a bank. It's the extra money that you receive, you get from having money in a bank. This is a little complicated or a little difficult concept, but let me make it easy for you. Let's say you have $10, right? You have $10 or manwon, and you put it into the bank. Usually, maybe the bank will give you 2% interest. 2% interest. That means after 1 year, they will give you 2% of the money you have in the bank. They'll just give it to you, just for having your money in the bank. What is 2% of $10? Well, 2% of $10 is $0.20, right? That's 20 cents. It's not a lot of money, but it is some money, right? And it's free. Well, it's free. You put it in the bank, you don't use it, and the bank gives you money. Why does the bank do that? Because if another person borrows $10, or if they borrow $10, then the bank charges them interest. That's a different type of interest. They might charge that person 5% interest. So basically, at the end of the year, that person has to pay back $10 plus 50 cents because 5% of $10 is 50 cents. Right? So if you borrow that money, you have to pay back $10 plus 50 cents. The bank, what happens with the bank? The bank, of course, what's the difference between 50 cents and 20 cents? Is 30 cents, right? So the bank makes money by doing that. Anyway, that's interest. The main idea is that if you put your money in the bank will give you a small percentage of that back every year, every half year. It depends on what the bank policy is. They will give you a small percentage of your money back in interest. So if you have a lot of money, you put it in the bank, you get interest on that money. You don't have to do anything, just keep it in the bank. Of course, the bank is using your money to make money themselves, and they give you a percentage of that. But that's interest. That's the extra money you receive from the money you have in the bank. Check. Okay, now, This lesson is, of course, from the American textbook reading series. Americans use checks, and this is a good picture of a check. Now, many countries don't use checks. For example, in Korea, you do not use checks. So it's a little difficult to explain this concept sometimes to Koreans. And in fact, I appreciate the Korean system more than I do the American system. When I was in America, of course, you have a savings account and you have a checking account. They're different. It might be the same bank, but your savings account, that's just money you put in there and you don't take the money out. You just get interest. But then you have a checking account. You open a checking account, you put money in there, and the bank doesn't give you checks. The bank makes you buy a checkbook with checks in it. That's another way they make money. Anyway, that's American banks. And then when you go to the store, right? You go to the store and you want to buy something. Now, you can use money, right? Just paper money and just give them the money. Or you can use a check, or you can use a credit card. So you're going to pay by cash, by check, or by credit. By cash, by check, or by credit. Those are three different ways to pay at a store or restaurant when you want to buy something. Now, a check, of course, is a piece of paper like this. It's in a book that you tear off. You might have 50 or 100 checks in your book. And it's a piece of paper that orders a bank to pay money from a checking account. Now, let me show you how the check works here. Up here, you put the date. So you might put August 5th. And then, of course, the year, 2020. And then you say, here it says pay to the order of, and you write the name of the restaurant. So let's say ABC Restaurant, ABC Restaurant. And then here it says how much? $1,000. Oh my God, what did you eat? Okay, I'm just kidding. But that's, $1,000 right there, okay? So then you have to spell that out. For some reason, they just put 1,000. You should put 1. And they already spelled out $1,000. And then here, that's optional. You can say, I ate 100 Big Macs, right? Big Macs. I was really hungry. Okay, and then you sign, right? You just sign your name on this part here. Now, what happens is you give that check to the restaurant owner, and the restaurant owner takes those checks. They get maybe many checks from many different customers. They go to the bank, and they put those checks into their bank account. Now, their bank might be ABC Bank, and your bank is XYZ Bank. So they put their check in the ABC Bank. ABC Bank sends the checks to your bank, XYZ Bank, and XYZ Bank takes the money out of your checking account and sends it to the restaurant owner's bank account. It's very complicated, okay? But that's how many Americans will pay for things. Now, paying by check is a little old-fashioned these days. Many Americans still use checks. Checks are still very common in America, but people are moving away from checks and they're doing internet banking or wire transfers. In Korea, of course, you do a lot of wire transfers or internet banking. I like the Korean system much better. Checks are old-fashioned, okay? Hopefully, Korea will never use checks, okay? It's much simpler just to have one bank account and don't worry about checks. And just have internet banking on your phone or just transfer money at an ATM, okay? Whew. But checks are a little bit complicated. But they're mostly in America, and other countries will use them as well. I'm familiar with the American system because I did use checks when I was younger. When I moved to Korea, no checks. Much easier. Count yourself lucky. Okay, next. Bill. What is a bill? A bill is a piece of paper listing costs that you should pay for using goods or services. Well, of course, you should pay your bills with money, obviously, but a bill, let's say you go to the grocery store. That's what this is. Looks like they went to the grocery store and they bought raspberries. And raspberries, what is it? $2.99. So they bought raspberries. Raspberries are $2.99. And they also bought, it looks like Italian Parmesan cheese, and that was $2.07. So the bill lists everything that they bought. If you go to a restaurant, again, using the restaurant example, you buy a meal, but you might buy a salad too, and a drink. All of those items are listed on the bill, and the total is on the bottom of the bill. The total is how much you should pay. And usually they also add tax to that. So that is the bill. And bills are just statements saying how much you owe a person or a company because you used their goods or services. Okay, that is a bill. Credit card, I mentioned this before. Of course, that's one of the ways to pay people for using their goods or services. You can pay cash, you can pay by check, you can pay by credit card. Of course, many people just say by credit. They don't say card, but that's okay. Credit card is a plastic card that you can use instead of cash. It's very convenient. It's much better than using a check. Just give them your card and it automatically takes the money out of your bank account. Well, that's a debit card. Credit card, when you use a credit card, that's a good difference. There's a credit card and there's a debit card. A debit card, it just automatically comes out of your bank account. With a credit card, at the end of the month, you get a bill. The credit card company will send you a bill. Say, okay, you used your credit card at this store. You used your credit card at this restaurant 2 days later. Every day, and the amount, the money that you used at each store is listed on your credit card bill, and at the end of the month, you pay that bill. So that's another example of a bill.
Lesson 12. In the bank. Deposit. To put money in a bank. In return. As a way of paying someone for something. Interest. The extra money that you receive from having money in a bank. Check. A piece of paper that orders a bank to pay money from a checking account. Bill. A piece of paper listing costs that you should pay for using goods or services. Credit card. A plastic card that you can use instead of cash. Savings account. A bank account that earns interest. Checking account. A bank account which you can take money out of at any time using your checkbook or cash card.